Hey traders, this is Blake Morrow with Trader Summit, and I have Mr. Jim Welsh from Macro Tides. What a big, monumentous week, Jim. Good to have you here to really go through it all.
Yeah, hey, I'm always glad to be here. And yeah, this week was somewhat momentous. At the top, I'm going to suggest and offer this past week's weekly technical review, because I went into great detail of what I expected the Chair Powell and the FOMC to do with their projections and dot plots. And on every single point, they did exactly what I thought they were likely to do. The letter explains why I thought they would take those steps, and I think people would find it of interest. Just send me an email, jimwelshmacro@gmail, and I'll send you this past Monday's weekly technical review.
Well, so in this Monday's technical review, we might as well just get to your first screen here. Now, I wanted to say, Jim, this is like a central bank bonanza. I mean, there was, and that I'm using that term and that phrase from my other colleagues that have. I mean, there's been almost every central bank on. It seems like every G10 central bank met this week and had something to say. So how did you come away from this week, and what did you tell us we should be thinking about?
Well, again, my expectation was that the Fed would do a similar thing that they did after the September meeting, and that is you use the projections and stuff to damp down enthusiasm in the markets. One of the things that's happened is because of the rally in the stock market, decline in dollar, drop in treasury yields, most of the tightening that the Fed did after the September meeting was taken back. So I thought the Fed would use the dot plots and projections to kind of say, hey, this is a wake-up call. So I thought the FOMC would lift the projection for the Fed funds rate to 5, maybe a little bit higher. They did. They went from 4.6 to 5.1. I thought they would lower GDP growth. And the reason being is if they're having to raise funds rate higher, it ultimately is going to have an impact on the economy and slow it down more. The PCE inflation, I thought that they would raise their estimate for inflation, which is somewhat counterintuitive, but I thought that they would use that as a point of saying, hey, getting inflation down is going to be difficult. It's going to take time. And one way to convey that message is to raise the PCE inflation estimate. They didn't raise it a lot, but in a sense, from 2.8 to 3.1 is a big jump. And finally, I thought that since they're projecting slower economic growth, that they would push back a little bit against the soft landing thesis by increasing the projection for the unemployment rate from 4.4 to 4.6. As you know, and anybody who's been listening to us in recent months, my take is the unemployment rate likely by the end of next year will be at 5% or higher. So again, I just thought that the FOMC has been delivering these messages in speeches, and Wall Street just has kind of ignored them. And quite honestly, that pattern is continuing, as you'll see in the next chart.
Yeah. And now, as I get into the next chart, I do want to point out, like last week, you thought the CPI would be a little hotter, and it really just came in a little like in line.
No, actually, I hate to say it, but whoever wrote that title got it wrong. I thought the CPI would be down. It was a question of whether or not it would be down enough to get the juices flowing, because as we talked last Friday, the PPI came in. It was down, but not down as much. So, as you know, for months, I've been talking about a big decline in the CPI coming, between September and next March. So, unfortunately, the title of last week's thing was wrong, and it's like, okay, it is what it is. I was expecting the CPI to come down. I thought there was a potential that on that news, that the market we would see the kind of rally that we did, and we'll get to that when we get to the S&P chart.
Okay, well, let's talk about rate cuts. So, I struggle with the idea that the Fed is going to actually, cut rates at least anytime in the near future while we still have inflationary pressures where they are. So, what is this chart telling you?
Okay, first of all, as we've discussed for months, the Fed doesn't want to do a repeat of the 1970s where they jammed on the brakes only to have to cut rates significantly before inflation was really run out of the system. So they want to go to a modestly restrictive level. They're finding their way. They will reduce like we saw 0.5 instead of 75 at some point in time. They'll go to 0.25 in terms of the rate hikes, but then they want to hold it. And what they're telling us, they want to hold it through all of next year. So not keep raising rates, but hold it so that slowly the full impact of all the prior rate increases really exert the downward pressure on demand and economic growth is what they're projecting. So in their dot plot, they said, we're going to hold it at 5.1% for all of next year. This is the Fed funds pricing. And what it is saying is that after May, they, the Fed funds futures guys think that the Fed will start cutting rates. And between the second half of next year and the first half of 2024, they will make 5 quarter-point cuts. So again, the Fed is delivered and has been consistently since September saying, we're going to get the funds rate up to a restrictive level and then hold it there all of next year. Wall Street continues to say, oh, no, you're not going to be able to do that. And it's not that I disagree. I get the logic. I think a recession is coming next year. But as we've talked, my take here is that when we get more and more signs that the economy really is slowing down, the Fed isn't going to do a pivot right away and start cutting rates. They're going to resist it because they don't want to repeat the mistakes of the 1970s. Okay, so everybody thought Powell's speech on November 30th was, dovish. I think they totally missed the point, Blake. And I think we touched about this last week. Basically, Powell did a pivot. He kind of said, inflation isn't the key thing at this point in time. The key thing is to see labor market tightness start to ease so that upward pressure on wages will come down because wages are the driver of service inflation. As he noted, it's like 55% of core non-shelter inflation. So, he said in that speech, 100,000 per month. That would accommodate, the growth in the number of people in the country. So what the Fed is, to me, is laying out here. They want to see labor market growth below 100,000 a month. We will see months where I think will be decline because he's consistently said, this is what needs to happen. We want wage growth, but we want it to be consistent with 2% inflation over time. So again, there was a pivot. Now the focus is the labor market, not inflation. So people who are just focused on inflation are missing the point. And so they think, oh my God, inflation's coming down. The Fed will be able to pivot. No, that's not what the Fed has told us. And I think that's an important message.
That is an important message. And I think, and this is something that I truly believe as well, as long as the labor market stays robust, inflation is going to have a more difficult time coming down, just period, end of story, right?
It is what it is. Okay.
Yeah.
So we got the CPI report, in the futures. I think the futures took out the high from, what was that, November 30th? December 1st.
Yeah, that was, we spiked above those highs, correct. Yeah.
Yeah, I mean, by a wider margin than 1 point. In fact, on the S&P cash, it was 50 points. Or 50 cents.
It was like way up here. Yeah, correct.
Yeah. So my point is, when you look at this chart from that high at 4101, you can see 1, 2, 3, 4, 5. So we got 5 down here. So at a minimum, I think we're going to see a bounce. If you look at the lower panel, that's a measurement. I kind of came up with this indicator, MACD on the RSI. And you can see it's starting to get oversold. So I think we're going to get a bounce, Blake. But ultimately, I think the market has to come to grips. And, we may get a bounce into year end, the seasonal for December. This is the window that it's most strong, the last 10 days or so of trading in December. But ultimately, I think, hey, we're going lower. And I think ultimately we'll test the lows from October around 3,500.
Yeah. This is it's, I was explaining to the community that I talk to all the time in the FX market. One of the risks that we have right now, if you're a bear, is that there's been a massive underperformance with asset managers this year as the 40-60, traditional 40-60 portfolio split between bonds and equities really hasn't worked at all. So everybody's underperforming the market in general. So there's got to be I don't want to say there's got to be, there could be a rush into the markets the last couple of weeks as everybody's just trying to mark up their portfolios. Wouldn't you agree with that?
Counterbalancing that. I mean, that's a good point, but counterbalancing that is everybody's got losses all over the place. So you're going to see some tax loss selling. Now, that doesn't apply to pension funds, but mutual funds, it certainly does, and individual investors. So I think it's just going to be, I think, really pretty choppy. I mean, I can also say, hey, from the high at 4,100, you got A down, 3 ways up to 4,101, 1, 2, 3, 4, 5, you completed an ABC, and that implies a bigger rally than just a bounce. But against the headwind of what's coming in the economy, additional tightening from the Fed, I just think one has to be conservative at this point in time, because ultimately, I think as we get to that point where the economy's weakening, the Fed is still talking tough, earnings estimates are going to start to get really marked down. And that's going to be, maybe it's a 1 or 2 month window of time, Blake, but that's when the market will be at its most vulnerable spot, because it's like, oh my God, we are going into recession. And we saw a little bit of that yesterday and today. Some data came out that was softer. And all of a sudden, everybody who's been believing that, yeah, we're going to get a soft landing, inflation's coming down, and there won't be a recession. I mean, it's like, what are you dreaming? So anyway.
Well, let's take a look at the dollar and how do you view the dollar at this point?
Again, the expectation was a pullback to 104, 105, a month ago or so. And obviously we've exceeded that. To me, what it looks like is we're approaching some important longer term support around 102. That trend line at 102 goes back, I don't know, probably to 2021 sometime. I'm guessing the summer of 2021. So I think that we're going to see a fairly decent bounce coming early next year as people start to realize, wait a second, the Fed really is serious. And the net result is, I think some of the declines that we've seen in the 2-year note and Treasury bonds yields coming down as much as they have, I think some of that's going to get retraced. And as that happens, I think at a minimum, the dollar rallies to 107, 108, maybe closer to 109. The key will be, Blake, that first rally that comes off whatever low is struck, is it 5 waves? Because that'll tell us a lot in terms of how much of a rally we can anticipate. I think the dollar, the risk reward is not terrific.
So what is this green moving average that you have here before we move on?
Okay, I'm glad you pointed that out. The red is a 5-day, the green is 13-day, and it's a simple momentum trend following thing, so that when the red drops below the green, it's a sell signal, and when it gets above, it's a buy signal. And you can see over time, if you look through, the far left of the chart, it's a decent trend following approach. It catches the big moves. It gets chopped up if you go sideways. So we'll probably see a little bit of choppiness, I think, over the next 3 weeks or so going into the first part of next year. But again, like I said, I think we're setting up for a decent sized bounce in the dollar, and being short, I don't think is the right place to be. Okay.
All right. And gold. So what about gold then? Because gold's kind of grossly underperformed considering the move in the dollar, and it's underperformed silver quite a bit. So how do you feel about gold, especially given that we had a little bit of a false breakout here? I'm a little concerned about this move right there where you have marked up as 4, where we couldn't really clear that level. What do you feel, or how do you feel about this?
Again, a month or so ago, when gold was trading 1630-ish or so, I thought, okay, we're going to get a rally to 1750, 1780. When it happened a couple of weeks ago, my take was sell gold above 1770, because I am not sure what's going to happen next. We could get a pop towards 1830, 1850, with the upper horizontal trend line. It has to hold 1765. Again, I think there's still a chance. And I would get really bullish if gold dropped below 1616. I still think that potentially from the high in March of this year, we've had a 1, 2, 3. This has been a big ABC for wave 4, and that there's a risk that gold drops below 1616. If it does, my take has been that from the high at 2070 in August of 2020, that you had a big A down, B up to March of 2021, and now we're in wave C for a 1, 2, 3, 4, 5. And we don't have all, to me, you don't have all the pieces for that. So as I said, I'm not confident of, back when it was trading around 1630, I was pretty confident we're going to get a pop above 1750. Now I'm going to let the chart tell me what's coming next.
All right. Well, it sounds logical to me, especially with the way gold's been acting. You have a chart. Your last chart here is on yields. Yeah. And before I get into this, I just want to say, ladies and gentlemen, if you're enjoying what Jim's doing for you every week, make sure you give him a thumbs up, subscribe to the channel down below, because you can't get this content anywhere else but from Jim and his technical review, which you should email him so you can get the last one. So Jim, how are you seeing 10-year yields here?
Well, you can see the red trend line that goes back quite a ways, months and months and months. What you can see at the bottom when I think it was December 7th, that it got down to that 3.402. So we got that wonderful CPI report, and the 10-year wasn't able to take that out. So to me, that's a little bit of a warning. Well, you got this great news, and you couldn't run with it to at least get below there. As you look at the bottom, the RSI, you can see it got overbought in terms of yields coming down, or pardon me, oversold, yields coming down. And my guess is that we're going to see yields tick higher, up towards the 3.7 to 3.8% over the next few weeks to unwind this. I just think there's been a lot of short covering. We talked about it 2 weeks ago. I think I had a chart showing very large short position in the Treasury, the 10-year Treasury. And I think some of what we've seen in terms of strength is shorts covering. So I think the Fed is going to hammer on this point. We're going higher with the funds rate, and we're going to hold it there. And, over the next few weeks, now that the meeting's over, the Fed can give speeches again. They have a 10-day blackout meeting window before meetings. And I think we're going to see the messaging loud and clear. The other thing I'll point out, which is important, of the 19 people who put down their projections, 17 of the 19 were 5% or higher. So you're talking about a very unified perspective by the vast majority of people on the FOMC. So what's that tells us? We're going to hear speeches from those 17 people that are going to reiterate why they think the funds rate should go up to 5.1 or higher and be held for a long time. And, I think that's not going to be news the market wants to digest. It's just remarkable how this year, Blake, and we've talked about this, that Wall Street just hasn't paid attention to what the Fed's telling them.
Yeah. And I mean, it was even a classic case of it this week, that it took him the next day for the markets to really understand that the Fed chair seems like he does mean business. So it is interesting, and you've been echoing that sentiment literally all year long. So Jim, I want to thank you for spending your time with us. How do people follow you? What's the best way to follow your work?
Well, Jim Welsh Macro. I have a Twitter at Jim Welsh Macro, Macro Tides. And as I said, you send me an email for jimwelshmacro.com, and I will send you the weekly technical review. I just feel, Blake, that after 40 years, I understand monetary policy pretty well. And I think the guidance and information I've provided this year has been above average.
To say the least. And remember, you can go back on YouTube and listen to all of Jim's previous commentary. He does some great work, and he gives a lot out here each and every week. So Jim, I want to say thank you for joining us every week. I hope you get your holiday shopping done this weekend, and we can catch up one last time before the Christmas holiday.
Hey, thanks so much, Blake. You have a wonderful weekend, and happy holidays to everyone.
Thanks, Jim. We'll talk to you soon. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.